All right, so today we're jumping into the pretty wild world of leveraged ETFs. We're going to focus on one in particular, SOXL, which is a 3x fund for semiconductors. Sounds exciting, right? But here's the thing. Underneath that promise of huge returns, there's this hidden trap, a kind of mathematical glitch that can literally eat away at your money, even when you think you're winning. So yeah, let's get into it.
I mean, it seems so simple, doesn't it? The semiconductor index goes up 10%, you should make 30%. Easy peasy. And that idea is so tempting, especially with a hot sector like semis. But, and this is a big but, that promise of getting 3x returns over any real length of time, it's pretty much a myth. The real story, the one that can save you a lot of money, is kind of hidden in the mechanics of how these things are built.
Okay, so this is the ETF we're talking about, SOXL. And its goal is super specific. It's designed to give you 3 times the performance of the semiconductor index. But here's the absolute key, the single most important word you need to remember. It does this on a daily basis, just for that one day. And trust me, that one little word, it changes the entire game. So why is that word daily such a huge deal? Well, to get it, we've got to pop the hood and look at the engine that runs this thing. It's a process called the daily reset. And this one mechanism is responsible for both the incredible short-term power of SOXL and its biggest, most dangerous flaw. So what exactly is this daily reset? Just picture the person managing this fund. Every single afternoon when the market closes, they basically have to hit a giant reset button. Their entire job is to rebalance everything so that the next morning, the fund is set up to deliver exactly 3x the index's return, but only for that one single day. And this constant shuffling of assets every 24 hours, it creates some really weird, unexpected consequences. And here's where it gets kind of wild. This daily reset forces the fund to do the one thing every investor is told never to do. Think about it. On a day the index goes up, the fund's value grows. So to keep that 3-to-1 leverage, they have to buy more shares at that new, higher price. They're buying high. And on a day the index goes down, the fund has to sell shares at a loss to get back to its target. They're selling low. It's literally built to buy high and sell low every single day. This whole process creates something called path dependency. It's a fancy term, but the idea is simple. With these ETFs, the journey is way more important than the destination. Normally, if a stock goes from 100 to 110 and back to 100, you've broken even. But not here. If the index ends up right back where it started after a month of ups and downs, you'd think your 3x ETF would be flat too, right? Nope, you'd actually have lost money. That daily cycle of buying high and selling low has been quietly eating away at your investment the whole time. Okay, so this daily rebalancing mess brings us to the absolute core idea we're talking about today. It's a kind of invisible value killer, and it has a name: volatility decay. You can think of it like a hidden tax on your returns that gets bigger the more the market bounces around. It's this corrosive effect that explains how these funds can literally just bleed money, even when the overall market is just treading water. And this is it. This is the moment where it all clicks. Get this. If the main index goes up one day and then down the next, ending up right back where it started, the 3x ETF won't be back where it started. It will be down. It's not a maybe, it's not a probably, it is a mathematical guarantee. It has to lose money in that scenario. Don't believe me? Let's run the numbers. Okay, just follow along here. The math is actually super simple, but it reveals everything. Let's say we start with $100 in the regular index and $100 in our 3x ETF. Day 1, the index goes up 1% to $101. Awesome. Our ETF goes up 3%, so we're at $103. We're feeling good. But then on day 2, the index drops 1%. So it lands at $99.99, basically right back at break-even. But what about our ETF? Well, it has to lose 3%, but it's losing 3% from its new higher price of $103. So it actually drops down to $99.91. So let's just pause on that for a second. The regular index is down a single penny. A penny! But our fancy 3x ETF is down 9 cents. That little 8-cent gap between them, that is volatility decay. And I know, 9 cents doesn't sound like a disaster, but imagine that happening over and over, day after day, in a market that's just chopping back and forth. That decay starts to compound, and it becomes this massive anchor, constantly dragging your returns down. Okay, so that's the math, that's the theory. But the big question is, does this stuff actually play out in the real world? Let's find out. We're going to compare SOXL to its regular non-leveraged counterpart, SOX. SOX just tries to match the index one for one.
Now, you have to see this. It's pretty shocking. This is the year-to-date performance. The regular index, SOXX, had an amazing year, up almost 27%. So simple math says the 3X version, SOXL, should be up what, like 80%? It should have crushed it. But look at the numbers. It's actually lower than the regular 1X ETF. I mean, how is that even possible?
Well, the answer is exactly what we were just talking about. Even though the overall trend was up, there were enough choppy days along the way, a day up 2%, a day down 1.5%, another up 3%, for that volatility decay to just do its damage. That constant buy high, sell low mechanism was so strong that it literally erased all the extra gains you were supposed to get from leverage. It happened even in a great market.
All right, now let's zoom out to a full year, a more volatile period. And this is where the danger really becomes crystal clear. The normal index fund, SOXX, still had a great year, up over 17%, a really solid return. But SOXL, the 3X fund, it didn't just do worse, it got crushed. It was down almost 9%. Think about that. The market went up 17%, and this thing lost 9%. That's the combo punch of leverage on the down days, plus that constant volatility decay, creating a totally brutal result for anyone who tried to just buy and hold.
So just how crazy volatile is this thing? Well, there's a number for that. It's called beta. A beta of 1 means you move in line with the stock market. The regular semi-index, SOXX, has a beta of 1.34, so it's a little more volatile than the market, which makes sense for tech. But SOXL, its beta is a whopping 4.08. That means in the real world, it's moving more than 4 times as much as the overall market. So it's not even really a 3X fund. In practice, its volatility is even higher. That requires some serious respect.
So what's the bottom line here? Is SOXL just a terrible investment? Well, no, not necessarily. It's better to think of it as a professional tool, like a surgeon's scalpel. In the right hands, for a very specific short-term job, it can be effective. But if you're an amateur who doesn't understand exactly how it works, you're going to do a lot of damage. This is a weapon for traders, not a building block for investors.
And hey, don't just take my word for it. This is a quote straight from Direxion, the people who actually make SOXL. They say it right on their website. This thing is for sophisticated investors who get the risks and are watching their portfolio like a hawk. They're telling you themselves, this is not something you just buy and forget about. So if you are one of those traders who wants to use this tool, what are the rules of the road? Well, there are 3 big ones. First, your holding period has to be super short. We're talking intraday, maybe overnight at the absolute most, not weeks. Second, your position size has to be small. Remember that 4X volatility? A little bit goes a long way. And third, you need a catalyst. The best use case is trying to ride a very short, very powerful wave of momentum, like right after a huge earnings beat or some other massive news.
And really, it all comes down to this one simple question you have to ask yourself. Who are you? Are you a trader, glued to your screen, trying to scalp a quick profit on a move that lasts a few hours? Or are you an investor, trying to patiently grow your capital over the next 5, 10, 20 years? Because once you answer that question, you'll know exactly whether a product like SOXL is a useful tool or just a trap waiting to spring.